Can you keep up with the pace of market regulatory reform? MarketsReformWiki.com, the place to keep up.
From the whole mandating of central clearing to CEF trading, the issues around what's the shape of the market? Is it going to be a central limit order book or RFQs? And if it's request for quotes, how many people are you going to have to send out for a quote? What even the products are going to look like? Are they going to be more futures based or are they going to look more like swaps? How's the margin process going to work? How's clearing going to work? There's discussions about extraterritoriality, if I can say that word right, of data, and if transactions are done with a U.S. counterparty, even if they're done overseas, or if the overseas organization has an entity here, will the information need to reside in a U.S. repository? And how does that look? And are sovereign wealth funds going to want all of this information discoverable by the U.S. government, even if the transactions are not done in the States or even with a formal U.S. counterparty? They just happen to have an office here. There's issues around clearing. There's fights between London and Europe as to if it's a euro-based product, will it have to be cleared in Europe and not cleared on British soil? How does that work? Does LCH need to go relocate to Paris? The 1.4 trillion number is kind of if everything kind of moves, and the question will become is, will there be any margin offsets? Will there still be a bespoke market? There are still a lot of questions, and how long will this transition take to get there? But whatever, yes, if everything moves, we're looking at a very large number, 1.4 trillion. Who's going to bear the cost of the margin? At the end of the day, it's going to be the end user, or the hedge fund or the asset manager, the person who's actually engaging in the swap. They're going to wind up having to pledge margin for these products, and they're going to wind up either pledging cash or collateral, or I'm sure the brokers and banks will be more than likely to finance that, and that'll just be rolled into the cost of that swap. Absolutely. I think that the issue of how clearinghouses handle margin is one of the big issues that they're trying to figure out. So let's talk about, we're here in Chicago, let's talk about the CME, one of the largest clearinghouses in the world for futures, okay? Now, all of a sudden, they're doing CDS or IRS or whatever. If I'm long futures and short IRS, or short futures and long IRS, do I need two pots of margin that are separate and distinct? Because, hey, look, I've got the long position and the short position, can I just net off my margin and have a much lower amount of margin? And there are pluses and minuses to both of those. Certainly the regulators want to make sure that there's enough margin in case something, God forbid, happens. That said, the end client doesn't want to have double margin for what intents and purposes is a flat or close to flat position. And so all these things need to be worked out. And then the other question is, on the third hand, if you can have three hands, if I'm just a small futures player, clearing member, and I am pledging, and I have a default fund, and I'm pledged to back the futures margin pot, and all of a sudden there's cross margining and somebody goes down and the calculations weren't correct. Am I gonna is somebody gonna hit me on the futures side for some problem on the swap side, which could conceivably happen if the margin pools are consolidated or offset incorrectly. So there are all these questions that unfortunately, need to be answered that we're still trying to work our way through. That said, there will be some sort of portfolio compression, netting, pot margining that will need to get accomplished, whether it's handled by the FCM, whether it's handled by the clearinghouse, whether it's handled by some integrate cross-linkage. Otherwise, what could happen is that the amount of margin that's needed to be pledged just makes all these transactions non-economic, and the whole market just falls apart. That's the whole battle for the within the clearing business right now, or in the clearinghouse business. So you've got CME that has a very large, futures clearinghouse. You have LCH has very huge interest rate clearinghouse. You've got ICE, that has very large CDS clearing business. The question will be is who can best assemble enough offsetting collateral and positions to reduce the margin. If you think about it, the transaction costs for matching you and me together are going to be fairly de minimis. However, it's a 20-year platform. I've got 20 years of margin that I have to manage, and so, as well as what could be millions of dollars in collateral or tens of millions of dollars in collateral that I have to pledge. So the cost of the transaction increasingly will not be the spread. It will not be the fee that the exchange or SEF takes out of it. It will not be the market impact of the trade. It's going to be what happens with this, with these millions of dollars in collateral that I'm going to have to manage over a long period of time. That's going to be the big cost, and the question will be is that's where a lot of the competition will wind up being on in this whole market.